Hello and welcome to Lecture 5 of our Introduction to Derivatives class. And so this week we're going to be learning about three different topics. We're going to be learning about the volatility surface, which is made up of the volatility smile and the term structure of volatility. We're then going to learn about exotic options. And finally, we are going to look at structured products, which relate quite strongly to exotic options. So for this week, we'll be looking at three chapters of your textbook, chapters 11, 14 and 18. And once again, I recommend that you really read these chapters as well as, watching these video lectures, because there is obviously a lot of additional color provided in the book that I don't have time to explain in these 1 hour lectures. But hopefully we will learn quite a lot today. So our first topic is the volatility surface, and the volatility surface is made up of a combination of the volatility smile and the term structure of volatility. So we'll firstly learn about volatility smiles. So in order to see what the volatility smile is, you have to plot the implied volatilities of options on the same underlying with the same expiration, but with different strike prices. So what we do is we'll say if there's an underlying, and there might be, 20 different options out there, all on that same underlying with at least different strike prices with the same expiration. And so what we do is we back out the implied volatility from each of these and we simply chart it. Now, when we do this, you will often or usually see a line that slopes upwards on either end, and thus it's referred to as the volatility smile. Now, under normal financial theory, we would say that the volatility smile should not exist, in that all of our methods, we talk about the volatility of the underlying with this idea that there is an underlying and that it has a standard deviation, and that should be plugged into our pricing formulas and thus give us the answer to how things are priced. But in the real world, what we found is that different strikes of options on the same underlying and with the same expiration often are trading with different implied volatilities. And there's a number of reasons that this might happen. And in fact, it's an ongoing area of academic research because people are still trying to explain why the volatility smile exists. There are a number of theories. One is simply that options pricing is just driven by supply and demand, and that there's more demand for out of the money or in the money options than there is demand for at the money options. Other people argue that there is more demand for out of the money put options, and there's a lot to be said for that argument, in that many of the users of options, many of the people that you find invest in options are often buying put options. That's sort of the big option out there is put options. And the reason people are buying them is to reduce their risk, to hedge their equity portfolio. So we'll say, for example, there might be a big asset manager out there and he's worried about the fall in the stock market, and so he might just buy puts from time to time in order to protect himself from losses associated with a big decline. And so many people feel that the options market works largely as an insurance market, and that there's more demand for out of the money put options because they protect you from the downside, and out of the money is cheaper than at the money or in the money, and thus you see greater demand there. Other theories exist. Some are quite interesting. There are some people who argue that volatility should be higher when the price of a stock falls, because when the price of a stock falls, the equity value is less, and thus the company itself is more levered. It's got more debt compared to equity than it had before, and thus it should be more volatile, and therefore it's reasonable for low option strikes to trade at higher implied volatility. But anyhow, there are many theories like this, and we don't really know the full reason, but this volatility smile or skew does exist. It's different in different markets, and we'll talk about that in a moment. Equity options traded on American markets didn't really show a volatility smile before the crash of 1987. So for a good while, options actually did trade usually at roughly the same implied volatility for different strikes. And after the 1987 crash, this skew in equity volatility appeared. And so that gives lead to the idea that it relates to people protecting themselves from extreme moves in the price of the stock market. They're protecting themselves from another 1987 crash. But anyhow, let's move on to our next slide and we'll take a look at the volatility smile. So if you look at this chart, you can see the smile in the middle of it, that curved line. And at the bottom, we have the strike price. So when we move to out of the money puts or in the money calls, or if we move to out of the money calls or in the money puts, you can see that the implied volatility is higher in those strikes of options. So volatility increases as options become increasingly in the money or out of the money. And that is what the volatility smile is. Now, our next slide, volatility smile in equities. Equities follow a common path in that they usually have higher volatility associated with share price declines and lower volatility associated with share price rises. And this is known as skew. Now, the smile that we saw on the last slide, the smile is something that you maybe see more in foreign exchange options. And that's a little bit interesting because for a foreign exchange option, we'll say, for example, if a pound denominated option on the US dollar, a call option on the dollar is the same as a put option on the pound denominated in dollars. So there's, with currency options, puts and calls are sort of interchangeable. And for that reason, maybe we see more of a smile. And in equities, we see skew. But if we look at the chart there, we can see that low strikes tend to have higher implied volatility, and high strikes tend to have lower implied volatility in equities, and this is the volatility skew. Okay, so if we look at the next slide for implied distributions, volatility smiles help to take into account that the behavior of stock prices in the real world is actually different to the geometric Brownian motion and the log normal distributions assumed in many option pricing methodologies. So I'm sure many of you have already heard people talking about this topic, and they say, well, you know, stock prices actually have fat tails, you know, that they're not normally distributed, that extreme moves happen more often than would be expected based upon a log normal distribution. And there are many people who really criticize formulas like the Black-Scholes model because, you know, one of the assumptions is that stocks move with this geometric Brownian motion and that the prices are log normally distributed. Well, to a certain extent, this skew and the smiles take this into account, because when you have a skew, when you have a higher price for out of the money options and in the money options than at the money options, what that really does is, if you were to flatten out the smile and look at the distribution that's implied by that, you would see a distribution with fat tails. So in particular with the skew, with the image we're looking at on the screen right now, you see the skew, and that's implying that the left tail of the distribution is wider than a log normal distribution. It's equally showing that the right tail is fatter as well, but in particular the left tail is showing has been significantly fatter than you would expect if stock prices were normally distributed. So to a certain extent, the smile and the skew that exists in option markets relates to traders adjusting for the real world distribution and the fact that extreme moves happen in markets more frequently than a normal distribution would imply. So the skew or the smile implies a distribution with fatter tails than would be normally expected. So our next slide, skew as a measure of fear. So option skew, which is constantly changing throughout the day as options trade, can be viewed as a measure of fear in the marketplace at a given time. Because if we think about the option skew relating to an implied distribution of returns, essentially when the skew steepens, what that's really telling you is that traders in the market think that a tail event is more likely now than it was before the skew steepened. So in our question here, it says, what does it mean if the S&P 500 index skew steepens significantly over a day? It means the traders are worried about extreme moves, and they have been bidding up, they've been buying out of the money or in the money options, and that has driven up the price of those, and essentially the traders are protecting themselves. They're preparing for a large move in the market. So that's what it means when we see the skew either steepen or flatten, is that you can think of that as a measure of fear in the markets. So that is smile and skew, and as I explained, smile tends to be more related to markets like foreign exchange markets. Skew is something that you see a lot more in equity markets. The next thing we're going to talk about is the term structure of volatility. And so in addition to the volatility smile, options of different maturities also display characteristic differences in implied volatility, and we refer to this as the term structure of volatility. So the term structure of volatility is the relationship between implied volatilities and time to expiration. So if you were to plot all of the different options out there in terms of we'll say if there's 1 month options, 2 month options, 3 month options, all the way out to 12-month options, all with the same strike price, the same underlying, and we just plotted the volatility, you would see that each of these is trading at a different implied volatility. Now, this is less surprising than the smile, and the reason for this is because it's not surprising. It doesn't violate any of the ideas of our pricing models that options that expire at different times should have different volatility, because we'll say, for example, if a volatile event is likely to happen over the life of one option but not over another, you'd expect a different implied volatility. So an example of that might be, we'll say if there's a big national election going on in a country, and the election is in 2 months' time, and there's a 1 month option available and a 6 month option available, you'd maybe expect the 6 month option to have higher implied volatility because you have to hold that through this big election that could move markets, while the 1 month option will have expired well in advance of that election. So it's not really surprising that options that have different expirations have different implied volatility. But once again, we're able to plot that, and when we plot that, we come up with what's called the term structure of volatility. And that provides another method for traders to gauge cheap or expensive options. So traders are able to look at all of the different options out there, whether they are different strikes or different expirations, and decide which ones are reasonable for them to either be a buyer or a seller of. So that moves us along to the concept of the volatility surface. And the volatility surface is what we get when we combine the smile or skew with the term structure of volatility. So the volatility surface is a plot of implied volatility as a function of both strike price and time to expiration. So it's essentially, if we look at all of the options that are out there, whether they are different strikes or different expirations, and we plot the volatility of all of those in sort of a 3D chart, and we will see both the smile and the term structure simultaneously. And so the implied volatilities for recently traded options will be plotted in this. Now, often when people look at things like the smile, if you have a Bloomberg terminal and you pull up a chart of the volatility smile or of the volatility surface, you might sometimes see quite unusual spikes in that. Now, some of that is often due to the fact that maybe one or two of the options have not traded in a long time, because these things are not trading every second the way single stocks might be. There can be days when a particular strike and expiration have not been traded. So sometimes you see stale prices in there. So in order to have a more accurate chart, what usually is done is that you plot the recently traded options as the actual implied volatilities they traded at, and then you use a linear interpolation method to show all of the other data points. So then when we move on to our next page, we can see here the volatility surface, figure 11.8 in your textbook, and that is showing you a combination of the smile and the term structure of volatility. And so you're able to look on there and see which options are expensive, which ones are cheap relative to each other. You're also sometimes able to see whether big events are expected with a stock. So for example, if a big volatility event is expected to come up quite soon, you might see a big hump in the volatility surface relating to that. So to a certain extent, you can often look at the volatility surface, see that traders are worried about something occurring at a given point in time, and almost look up the news on the stock and try and work out what it is that traders are worrying about. So that is the volatility surface. Hopefully you guys understand that fairly well, and do take a look at the chapter in your textbook if you are at all confused. So the next thing we're going to move on to is exotic options. And exotic options, I remember when I first was learning about derivatives, I was quite excited by exotic options because, you know, they're called exotic options. It sounds much more exciting than vanilla or plain options. In truth, they tend not to necessarily be more useful, but they tend to have unusual payoffs. So they also tend to be a lot less traded. So there's much more of a business in our regular puts and calls than there are in these exotics. Exotics tend to trade an awful lot more in Europe than they do in the United States, for example. And one of the reasons for that is just that there's a bigger business in structured products in Europe than there is in the United States, and a lot of that relates to laws. So it's easier to sell a product to an end investor that includes a derivative in Europe. In the United States, if you are going to sell a derivative to an investor, you have to have them sign a disclosure form disclosing all of the risks associated with the derivative, and that often puts people off of actually investing in that product. So the exotics business is much bigger in Europe because the structured products business is bigger in Europe than it is in the United States. Most options traders trade vanilla options. quite unusual for people to really be trading exotic options, other than if they're putting them into structured products. So let's see what exotic options are. So simple put and call options, or combinations of them, are referred to as vanilla or plain vanilla options. And this is just a terminology that you hear a lot in markets. You hear, when we get onto swaps next week, you'll hear about plain vanilla swaps, and that just means an ordinary everyday one. And then the kind of quite unusual products are differentiated from plain vanilla products. So our plain vanilla options, like puts and calls, have standard properties and they trade actively. They're usually also exchange traded and cleared, while a lot of the exotics tend to be over the counter and they have non-standard or unusual features, and so they tend to be more difficult to price. So exotic options are non-standard options, and they serve certain market niches. So some people may need to trade them if they have a very specific hedging need. Sometimes they are used to get around certain tax rules, accounting rules, legal or regulatory rules. And some of them are designed to pay off in very particular market circumstances that a fund manager or corporate treasurer may want to be able to receive a payoff based upon. So our exotic options have non-standard features, and that can really be anything. Some of them can be a hybrid of American or European style. So rather than having an American option or a European option, you can have something in between. They can have alternative payoffs that don't depend precisely on one strike. They can have fixed payout options above a certain strike, or they can pay out the average underlying performance over the option life. So there are many different unusual payoffs that we're able to structure and that we're able to price options based upon. Okay, so let's look at our first exotic option. And the first exotic option we have here is called a Bermudan option. And it is somewhere between an American and a European style option. So if we remember from, I guess it was class 2, a European option can only be exercised at maturity, and an American option can be exercised at any time before maturity. And so these are called Bermudan options simply because Bermuda is physically somewhere between the United States and Europe. And these options are something between an American and a European style option. So instead of being allowed to be early exercised at any point in time like an American option, a Bermudan option can be exercised on certain dates during the life of the option. So if it's an option that expires in 3 months, maybe once a month you get the opportunity to early exercise it should you desire. Now, obviously you guys realize that we can use a simple binomial tree in order to price a Bermudan option. And all we do is the same type of adjustment that we did when we were pricing an American option, except it's only at certain nodes that you get to make that decision. Now, it probably should also be obvious to you that the price of a Bermudan option is probably somewhere between that of an American and a European option. So because it gives you greater flexibility than a European option, because you're able to early exercise it, it should be worth more than a European style option. But because you can't early exercise it whenever you want, it should be worth a little bit less than an American option. So this is an exotic option, but as you can see, it's not, there's nothing really that complicated about it. And based on what you learned in prior classes, you should already know how to price an option like this. Our next option is kind of an interesting one. It's a forward start option. So this is an option that starts at some point in the future. And often employee stock options will be structured like this, where someone will be granted options that are at the money options that are granted to them, we'll say in 6 months' time or something like that. So you don't know what the strike price will be of the option. It's been granted, you've been given the option, but the strike price will be set on the date at which we'll say that option vests for you. So it'll be an at the money option. So whatever price the market is trading at when you are given that option, or when you are allowed to exercise that option, is also what the strike price will be with that. So that is a forward start option. And once again, it's not hugely complicated. It's just a little twist on a standard call option. So there you go. Our next options, our next exotics, are called compound options, and these are options on options. So this could be a call that allows you to buy another call. So it's a call option where the underlying, instead of being a stock or a bond or a commodity, is actually a call on a stock, a bond, or a commodity. So you can then have, obviously, calls on calls, calls on puts, puts on calls, or puts on puts. And the underlying asset of the first option is simply another option. So it's really, in truth, kind of a more levered form of option. And you should already know how to price those as well. It's simply like a Black-Scholes type model or a binomial tree in which you really just solve it twice. So you solve it for the underlying, or you solve it with the underlying and then with a call on the call that you've just solved it for. So that is compound options. The next option we have is called, the next exotic option we have is called a chooser option. And the chooser option is an option where after a certain time you're able to decide if the option is a call or a put. Now, I remember when I first heard about these, I couldn't understand why they would be priced any different to a straddle, right? Because a straddle is if you bought a put and you bought a call on the same underlying. Now, with a chooser option, it's an awful lot like a straddle, obviously, but the big difference is that you make this choice in advance of expiration. So essentially it's almost like a straddle where you discard one of the two options. We'll say if it's a 3-month option, maybe you have to make that choice 1 month before expiration. So once again, you'd expect it to be priced sort of similarly to a straddle, except it should be cheaper because you are discarding one of those options early. And for example, we'll say if over the first 2 months of a 3-month chooser option, the market had trended up and up, and you decided to choose that it be a call option at that point because the call is nicely in the money. It is quite possible that over the final month, maybe the market falls and you would have liked to have the put, but that's not what you chose. So that is a chooser option. It's similar to trading a straddle, but it's going to be a little bit cheaper than a straddle because it's not quite as good as a straddle. So that is a chooser option. The next products we'll look at are called barrier options, and these are quite interesting exotic options, and they traded a reasonable amount, and the payoff depends on if the underlying hits a certain level before maturity. So these are what we call path dependent options. So a barrier option usually knocks in or knocks out. So let me explain that a little bit better. If you had a barrier call option that knocks in at a certain level, how that might work is that it's a call option. It might have a strike of, we'll imagine it's an at-the-money call option, so the underlying is trading at 100. It's a call option with a strike price of 100, but it has a knock-in at 95. Now what that means is that if the price were to go up and up and up, it's not activated. What has to happen is it has to go down and go through that price of 95, and that knocks in our barrier call option. It goes through the barrier, which is 95, and that knocks it in, and now it has become like a vanilla call option. You could also have a call option with a barrier that knocks out. So once again, it could be a barrier at 95, again on the same kind of an option, but it would be like a call option. But should the price at any point over the life of the option fall to 95, like trade through the price of 95, that would knock it out, that would deactivate the option. So obviously you'd expect these to be an option that has to knock in would obviously cost less than a vanilla call option, because it has to do two things in order for you to get your payout, while with a vanilla option it just has to go up. And so people like to buy barrier options simply in order to make it cheaper for themselves so they can spend less on premium. An option that knocks out like that equally would be less expensive, because a regular call option the underlying could fall to 95 and then continue up to 150 and you'll get a payout, while with the knockout option it's knocked out, so that's bad for the owner of that option, and thus it makes it cheaper. So options can be up and out, which means that if they go up they get knocked out. They can be down and out, meaning that if the price falls they get knocked out, and that can be for either calls or puts. And then they can be down and in, meaning that they get activated once they hit the barrier and the barrier is down, or up and in, which means that they get activated when they go up, and that can be for puts or calls. Now, as you can imagine, the Greeks on barrier options are quite different to vanilla calls. So we'll say, for example, when we think about the first one we spoke about, which was a call option with a strike price of 100, that's at the money, with a knock-in at 95. Now with a vanilla call option that doesn't have that knock-in, as the price of the underlying fell, you would expect the delta to fall, while with a knock-in you would see the delta increasing as it goes towards the knock-in barrier, because if it's rallying away from that barrier without having knocked in, it becomes less likely to pay out to the end investor. So that is barrier options, and they're quite interesting options. And as I mentioned a moment ago, a lot of the reason that people would trade a barrier option rather than a vanilla option is really just to buy that option a little bit cheaper. But it obviously is cheaper for good reason, in that it is less likely to pay out than a vanilla option. So our next slide shows figure 14.2, which shows options with their barriers. So we see the path of the underlying, and as you can see, the first chart here, the price has gone close to the barrier. It's a knock-in option, but it hasn't gone through the barrier, and thus it didn't get knocked in, even though it goes through the strike price. It never got knocked in, so it's not activated. The second chart we have here, you can see that the price went through the barrier, and thus it can now be exercised. Now it's like a vanilla option. So that's barrier options, and that has introduced you guys to the idea of path dependency in options. So a barrier option is a path dependent option. Our next options are binary options, and these are discontinuous payoff options. So instead of the payoff of a binary option being something like the difference between the spot price at expiration and the strike price, it'll just be a simple we'll say $1 payoff. So for example, if it's a binary call option, if the underlying at expiration is above the strike price, you get a payout. We'll say it's $1. And it doesn't matter if it goes way through the price or if it's just slightly above it, you get the same payout. So you either get 1 or 0. There's no other payouts available. So that is called a binary option. Binary options are exotic options. They tend to be less traded than vanilla options. They're more difficult to hedge than vanilla options because their Greeks become quite unstable around the strike price simply because they're flipping between, the delta is flipping between 1 and 0 a lot, especially close to expiration. So that is what a binary option is. So our next option, our next exotic option, is a gap option. And a gap option is a type of barrier option where the strike making the option exercisable differs from the strike used to calculate the payoff. Gap call options pay off ST minus K1 when ST is greater than K2. And the modified Black-Scholes formula can be used to price this style of option. We'll move on to our next slide now and we'll look at look-back options, quite an interesting kind of exotic option. And look-back option payoffs depend on maximums and minimums of underlying asset price points over the option's life. So once again, these are path-dependent options that allow the option owner to buy at the low or sell at the high over the life of the option. There are two types, floating strike and fixed strike look-back options. For floating strike look-back calls, the exercise price is the minimum stock price reached over the life of the option. For floating strike look-back puts, the exercise price is the maximum stock price reached over the life of the option. For fixed strike options, the strike is fixed like with a vanilla option, but for fixed strike look-back calls, the owner gets to exercise at the point when the underlying asset price is at its highest level over the life of the option. For fixed strike look-back puts, the owner gets to exercise at the underlying asset's lowest price over the life of the option. While these options sound like you can't lose at all with them, they are of course priced in a rational market and are considerably more expensive than vanilla options. Their high prices can be reduced by restricting the maximums and minimums used in calculating the payoffs, and these restricted versions are known as partial look-back options. So that is look-back options. The next exotic that we're going to look at are called Asian options. And this is, once again, it's worth noting that when we talk about things like American options and European and Bermudan options, that they're really just names given to them. So an Asian option isn't an option that's particularly traded in Asia. It's simply just a name that's been given to it. And so the payoff on an Asian option depends on the average price of the underlying over the option life or over some part of the option life. So the average can be calculated as either a geometric or an arithmetic average. And the real advantage of Asian options is they reduce the potential for one price spike, we'll say, right at the expiration date to either make you a lot of money or to lose you a lot of money, or, to make the option not pay off. Because of the volatility dampening effect of the averaging feature, usually these will be cheaper than American or European options. And the next ones we're going to look at are options on several assets. So the first type is a rainbow option, where delivery at maturity can be on a choice of a large number of assets. These are usually calls or puts on a best of or worst of a basket of a certain number of underlying assets. This is considered a type of correlation trading because the prices of these options are sensitive to the correlation amongst the basket's constituents. A basket option, the payoff depends on the performance of a basket of assets, which would be a set of individual stocks or indices or a group of currencies. So instead of the payoff being on one asset, it's on this basket. These are often used for currency hedging for institutions that might have exposure to a number of different currencies, and it often ends up being cheaper for them to use a basket option than to buy a whole bunch of individual options. Our next one up are Quantos, and Quantos are quantity adjusting options, and they're derivatives where the underlying is denominated in a currency other than that in which the option is settled. A Quanto basically has an embedded currency forward with a variable notional amount in it. Quanto futures, Quanto options, and Quanto swaps are all available. Quantos are often used when an investor feels that the underlying asset is likely to perform well, but they are concerned about the currency in which it's denominated in. So that's really it on exotic options, and as you can see, many of them are products that you can already price just using our standard approach as a modified Black-Scholes or a modified binomial tree approach. Some of them, the ones that are path dependent, usually involve other pricing methods such as the Monte Carlo method, and if you're interested in learning more about the Monte Carlo method, there is a chapter in the book on that topic, but it's not really covered in this course. But if you want to brush up on it, it's worthwhile taking a look at that chapter. So we're going to move on to the third part of this class, and that is structured products. And so structured products are, in theory, any over-the-counter investment product that requires tailoring or structuring to provide a specific risk exposure to suit a customer's need. Now, in real life, they're usually just made up of a bond and an option. So there'll be a bond with some optionality added in on top of it. Often the type of products that you'll see as structured products are things like what they call principal guaranteed products. And that will mean that we'll say an investor who puts in $1,000, if they invest $1,000 in a structured product, they'll be told that they're guaranteed to receive that money back at maturity. So the worst case scenario, they're told, is that they'll at least get their money back. We all know, if you work in the financial industry or at this point in your master's degree, you've probably worked out that there is a bit of a flaw in that. So if someone invests $1,000 and 5 years later they get $1,000 back and they say that they're at break even, that's usually not the case, because over that 5-year period they would be expected to earn interest on their money if it was just sitting in a bank account or invested in a bond. So what's really happening with a principal guaranteed product is that the investor has given up the interest that they would have earned. So if we look at our next slide here, we can see that $1,000 in this example goes into our product. A certain amount of that will be put into a zero coupon bond, and that's an amount of money that we'll say, for example, if you know that if you invested $950 of that money in a zero coupon bond, that at expiration that bond will be worth $1,000. Well, then what you have is you have $50 left over to spend on options. So a lot of the money will just go into the zero coupon bond, and the remaining amount is used to buy some sort of options. And then it's really just down to the structurer as to what kind of options they want to put in there. And that's usually driven by customer demand. Now, these tend not to be the most sophisticated products out there, and that the end investor, if you think about it, when someone is investing in something and they kind of like the idea that it's non-risky because they're guaranteed to get their $1,000 back, they're usually not someone who knows an awful lot about finance. And so then typically the kind of optionality that'll be included in there will be really whatever's popular at a given time. So if the news is filled with stories of gold and other commodities going up based on demand from another country or something like that, those investors might be excited about the idea of investing in commodities. And when they go down to their local bank branch, they're told, instead of putting your money in a savings account, you can put it in this structured product where you're guaranteed to get your money back, but you can also make money if a basket of commodities goes up in value, or if the FTSE 100 goes up in value, or if property prices go up in value, or really whatever product they might be interested in that can be structured within a derivative and added into a bond and made into a principal guaranteed product. So why investors are interested, what the structures are giving investors in exchange for this loss of interest is just this options exposure, which often sort of sounds a little bit exciting, and it sounds more interesting than investing in we'll say, just a savings account. Often the structures will have payoffs like twice the return of the FTSE if the FTSE index returns greater than 5% in each year for the next 3 years, and then that'll be capped at a maximum possible return of 12%, we'll say. So the reason that all of those things, like the reason that there's so many conditions in there, is that that's going to make the options cheaper. If it was just a call option tacked onto a bond, that would be expensive, and it would be difficult to fit that in with the amount of money that you might have to spend on interest. Now, in the current environment, we're in a low interest rate environment at the moment, and so you don't see an awful lot of structured products, because in a low interest rate environment, there's not a lot of interest being paid, and therefore there's not a lot of money left over to spend on options exposure. But, this tends to be, the structured product business tends to do well in higher interest rate environments. So where can structured products go wrong? For one thing, if the options never pay off to the customer. So that's sort of the most obvious thing, that basically they put their money in, they put in $1,000 for 5 years and they get $1,000 back. And in the real world, they've actually lost money because they've foregone 5 years worth of interest. That's the most obvious thing. Structurers and salespeople are not clairvoyant, and they can't sell, they tend not to necessarily go seeking out the best investment. Instead, they seek out the kind of investment that people are excited about at a given time. Sellers of structured products usually are hedging their exposures until the maturity of the trade. So whenever there is an option built into it, there's also the cost of hedging that option that is passed on to investors. And often, a lot of the criticism around structured products is related to there being high fees associated with these products. And in the past, that was very much the case. But the cost of these are coming down and down, essentially because there are more and more banks competing to sell essentially identical products. So the sales commissions are not as high on these things as they used to be. But that brings us to the next slide, is where people can lose money, is just if the fees are not fair. And often the payoff will be quite complicated. And so a student like you who's taken this class could probably sit down and work out the actual value of the options that you're getting within a structured product. But most of the people who buy them are really just buying them because it sounds kind of good, and they don't have the the education or the ability to price up the options that are in there, or whether they're getting a fair price or not. The next place that these structured products can go wrong is just quite simply if the bond defaults. And that can happen. Often the underlying bond in a structured product might be a bond issued by an investment bank. So for example, banks like Lehman Brothers that went bust during the credit crunch, they will have issued a lot of structured products with a Lehman Brothers bond underlying it. And so when we talk about the principal being guaranteed, it's in fact they've moved away from the term principal guaranteed to principal protected, because sometimes the bond risk actually can matter quite a lot within these products. So structured products, they're often, from time to time, it's been quite a big business on Wall Street, and maybe as interest rates go higher, that business will get quite big again. So structured products over time, the fees have been grinding lower and lower. So historically, they tended to be quite high margin, and this wasn't really too good for the investor. But because there are so many banks competing in the space, the fees have tended to come down. Equally, banks are trying to come up with more and more interesting payouts. And the real reason behind that is just so that they don't find themselves selling the exact same product as another bank and having to match their price. More and more we're starting to see kind of hedge fund like products built into to structured products. So instead of just having an option in there, there might be a trading strategy built in. For example, a strategy that relies upon selling options and trying to bring in the premium and pass that on to investors and that kind of thing. This is a space where there's an awful lot of innovation, and actually that's one of the great things about the derivatives market overall, is that it's one of the more innovative areas in finance. And so as time goes by, people are always coming up with new products and new structures that are largely driven by how interesting the end investor might find them. So that is the end of today's lecture. Hopefully you guys can review everything in the book, and we will move on to some new topics next week. We're about done with options and futures now, and we're going to move into swaps and credit derivatives after this. So have a great week, and we'll see you in the next class.